You can look at clues for the precious metals market with the ratio charts, and the gold to SPX chart is one of those.
Friday, April 28th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Kevin Wadsworth. He's one half of Northstar and Badcharts. And yeah, Kevin, welcome to the channel again. How are you?
Great to talk to you again, Mario. Thanks for inviting me on. It's always great to talk about.
Welcome, and I'll just show the viewers where they can find Kevin and Patrick's work. It's Northstar, badcharts.com. You've got a big presence as well on Twitter. I recommend people also follow Kevin on Twitter. What's your handle there, Kevin?
It's at Northstar Charts.
Okay, great. So I wanted to talk to Kevin a little bit about technical analysis. When I worked in the City of London, I used technical analysis and fundamental analysis. I don't use it as much anymore. I try to focus more on the fundamentals and the fragility of our current financial system. But it's always good to bring on Kevin and or Patrick, because they have, in my opinion, a really good way of looking at the technical analysis. They don't just look at silver or gold, but they look at it in relationship to other assets. So, Kevin, with no further ado, I'll let you take hold of the conch, so to speak.
Okay, thanks for giving me the stage here. I'm going to share my screen, and you'll just have to confirm for me whether you're seeing it or not, Mario. There, I'm glad you can see the screen. So I'll talk about what's happening with the precious metals at the moment, and we'll talk about silver in some detail. But just to set the background with with gold, which of course is the big boy in the precious metals market, so to speak. And this is the monthly analysis chart for gold. What you can see on here is it's a weight of evidence analysis. I'm a scientist by nature. My background is in predictive forecasting in the world of atmospheric science. And one thing that I learned over 34 years of trying to predict the future with the world's atmosphere is that you need to look at more than one just piece of evidence. So if you're trying to forecast the weather for tomorrow or the next day, you don't just take a look at what the current temperature is. You need to consider the humidity, the wind speed, wind direction, and every other element of the atmosphere to try and feed that into supercomputers to work out what's happening. And it's exactly the same when you're trying to forecast what's going to happen with stocks, shares, and gold and silver and all that kind of thing as well. So this is a weight of evidence analysis, and what that basically means is that there's a lot of different pieces of the jigsaw puzzle on this chart that's giving us clues as to where the price of gold might be going over the next few months and the next few years. Excuse me. So the first thing to notice is this very obvious cup and handle pattern. It's obvious in both of the precious metals charts, and it's a well-known technical analysis pattern. You can see the arc pattern here. It's a perfect geometric arc, which tends to form or does form during the basing process of a developing bull market. So you get the bear market where the price of gold descends for a number of years. Then it bases, it forms a sort of a sideways trend where you start to see the momentum favoring the upside rather than favoring the downside. So the downside momentum wanes as the buyers sorry, I beg your pardon, as the sellers begin to become exhausted and there are no more sellers in the market, and then you start to get a sideways chop, and then the buyers come into the market and eventually start to push the price up through a number of resistance levels that indicate that a new bull market is taking hold. Now, what happens after that? You hit an overhead horizontal resistance level and you form a consolidation. The consolidation can happen at much higher levels, well above the cup. It can happen at the top right-hand corner of the cup, which is what gives the cup and handle pattern that many of us are familiar with, or the downtrend can actually start lower down, and it can actually break the cup pattern. So the cup and handle pattern is very important, giving us clues as to where we're going next. But more importantly than that, really, is the confirmation that comes from breaking out through the support and resistance zone that was 1770 to 1825, and then we're broken above the main resistance line of this expanding wedge which forms the handle. That happened at around about 1920, and all that really remains now is to be breaking above this psychological resistance area, which is a sort of a horizontal resistance zone close to the 2000 level, and it's a convincing close above $2,000 when it comes that will signal that we're really on our way to the or developing the bull market continuation. Because once that happens, obviously it'll be clear to everybody, and I expect when it does happen, it won't be open to doubt. It'll be pretty clear and pretty obvious. We'll get a big green candle. It'll close somewhere around 2050, 2070, large green candle, and that'll set us on our way. Other pieces of evidence on this chart, the moving averages, the 12 and 36-month moving average, were above both of those. The Ichimoku cloud, which is this strange green and red splodges on the chart, which is technical support and resistance levels, were above that. And the rate of change indicator on the bottom, which is very, very important actually. This rate of change indicator is one of the few things actually that told me that 2021, 2022 is different, or was different, to this period around 2011-12. I think a lot of people were looking at the chart pattern that was forming over the last couple of years and comparing it to 2012-13. Now, you can see that the rate of change indicator gave a very, very different picture back at that point in time. We'd broken out, moved above the zero line, we'd had a long bull market, and then we broke down. The rate of change indicator broke down below the green line, that's its 3-year moving average, and signaled the time to exit. And if you notice, it actually signaled the time to exit well before most traders and investors cottoned on and actually did begin to exit. So it gave an early signal. It also gave a good signal for when to re-enter as the rate of change moved back above the zero line and above its 3-year moving average. We had the move above $2,000. Now, we have not, and this is important, we have not had a sell signal. The rate of change indicator is bouncing and has been bouncing on its 3-year moving average and continues to trend upwards above the zero line. So that's a good underlying hidden indicator of the strength in the market. Now, if we turn to silver, bearing all of that in mind, look at the silver chart, what you'll notice, and I think what a lot of people have noticed, is this cup pattern that's been forming over the last 10 years. It's very much like the gold chart that I just showed you. We are now starting to break out above some very important resistance levels. We're above the 12-month moving average. We're above the, I'll just adjust this actually, because I've just noticed that was the 48-month moving average on there. So I'm just going to adjust that to make it the 36-month moving average. Okay, so we're above the 36-month moving average. If I put the 12-month moving average on the chart there, that's the red line. We're above that. We're above the Ichimoku cloud. We've now pushed above all these horizontal resistance levels. So what I'm saying to you is that this is all very bullish, positive price action, but we cannot turn fully bullish on silver until we get above this wake-up line. It is basically a resistance line that tells us when the silver price is waking up and has proven to us that we are on for this target, which is up here in the region approaching $50. So when we clear through that price point there, which is around about $25 at the moment, $25 to $25.50. Once we push through that, it'll be a quick move to 28, and then we may need to pause for a while at $28. It just depends how spiky the move is and how solid the move is for gold. I suspect if gold moves to, let's say, at least $2,400, I expect silver to actually spike. And you'll notice, I think anybody who follows the silver market will notice that it tends to spike very rapidly and is much more volatile in its price movements than gold is. So I think it's quite likely that once we clear through this $25.50 area, we're probably not going to linger at 28 for very long. We'll probably just push on straight to the $38 to $50 level. So I expect once this zone here gets broken, I do expect a pretty rapid upside move. So in effect, what I'm saying is that we don't have to wait until 2025, the top right corner of this arc. We're probably not going to have to wait that long to reach the target. I suspect we're going to reach it earlier than that, and probably either later this year or into the early part of next year. So that's my timing for all that. The other thing to really note from this chart is that if you're expecting a nice handle to form on this cup, and thinking that that's quite likely. Well, it is possible, because this is a cup pattern which may form a handle before advancing higher and well beyond $50. But something just to bear in mind is that this actually is the handle on the cup and handle pattern. So the cup and handle pattern for silver has been forming for the last 50 plus years, since the 1970s. And this last 10, 12 years that we're sort of focusing on as a cup pattern is in fact the handle to a much, much larger cup. So the implications of this are pretty extreme, in fact. And what it does mean is that if we, or when we break through this $50 barrier, move upwards from here is likely to catch catch a lot of people by surprise. And I think triple digit silver is very, very likely. It's not, I wouldn't describe it as a possibility, but more of a probability. And my timeline for that, I would say, is the next sort of 3 to 4 years. So I'd expect by the late 2020s, we say 2027 to 2028, that kind of time, that we'll be seeing triple digit silver. That's what the technical chart is telling me. That's what it's suggesting it's setting up for. You can look at clues for the precious metals market with the ratio charts, and the gold to SPX chart is one of those. So if we zoom out a little bit, and I'll put this on the quarterly chart for you, what you're looking at here is a gold to SPX ratio. I'll just get rid of these those tickers on the side there to maximize the screen a little bit for you. So this is the gold to SPX ratio. And what it's telling you is when to be invested in gold and when to be invested in the stock markets. As the chart moves up, gold is in favor. And as the chart moves down, the stock markets are winning. As the chart moves up, gold is outperforming the SPX. As the chart moves down, the SPX is outperforming gold. Gold outperforming SPX, SPX outperforming gold. So a couple of fairly obvious observations from this chart is that when you're up at these sorts of levels above, let's say around about 3, when the reading is above 3, then that's telling you that gold is really getting to the point where it's at maximum value versus the stock market. And you probably need to start thinking about rotating back into the stock market. And the other observation is that once you get down to these levels, down below the solid red line, so below about 0.5, then that's telling you that gold is historically, I'm not sure if I like the term undervalued, but I suppose that gets across the message. Gold is somewhat undervalued compared to the stock market, and it's likely to be a good time to start accumulating gold. So there are extremes, or there was an extreme during the dot-com bust, of course, in 2000. But generally speaking, anywhere below that 0.5 line is a good time to accumulate precious metals. Now, we have been below that 0.5 line for quite a period of time, actually since around about 2018 or thereabouts. So the accumulation of precious metals over the last few years, I think when we look back in a few years' time, let's say we're looking back in the late 2020s, we're likely to view this period as a great time to have been accumulating the precious metals. There's a clear breakout line which I've highlighted, and there's 3 of these since the 1930s, where the chart gave the signal to go long gold versus equities. So a ratio chart, if you're not too familiar with ratio charts, what it's doing is it's telling you which is the winner in a 2-horse race. It doesn't tell you about anything else that you might want to invest in, but this is a 2-horse race between gold and the stock market. Why is this a good ratio to look at? Well, it's because gold and stock market have opposing capital flows. So as one's doing well, the other one's doing badly, and they don't come from the same investment category. Okay, they come from opposing investment categories. There's no point choosing 2 things that come from the same investment category. For example, you wouldn't choose Tesla and Meta to compare, because they both attract the same capital flows. You're wanting to look at overall, do you want to be invested in this sector or that sector? So you pick sectors that have opposing capital flows. And clearly at the moment, we're looking like we're about to get the 4th signal in 100 years. The first signal came around about 1931, next around about 1968. The next one from this chart gave the confirmation signal around about 2002. And the latest one came just a month or so ago, in fact, a couple of months ago. So what this now means is that even if this ratio chart trends sideways in this red quadrant, it's telling us that gold and the stock market are going to perform about equally as well or equally as badly. They are making the same gains or losses. Once this starts to move above the 0.5 line, this is why 0.5 is pretty important, it's giving a really strong signal that gold is outperforming and is set to outperform the stock market over a number of years. We will have already had the breakout from the descending resistance line. A breakout above the overhead horizontal resistance line is more important, and it's more evidential. It gives more evidence, more strong evidence, and particularly getting across this cluster of resistance lines that I've marked at around about 0.6, 0.7, then getting above those will give a really, really strong signal. And at that point, we'll be in a full-on precious metals bull market versus the S&P. So the S&P at the same time, by the way, is forming a bearish rising wedge, and is also struggling against inflation. When you chart the stock market versus inflation, it looks like a pretty bearish setup at the moment, and it's kind of hanging on a thread and ready to start moving to the downside. So the stock market looks vulnerable, precious metals look poised for a breakout. You put all that together with these ratio charts, and I think what it's telling you is that regardless of the shorter term movements, day to day, week to week, from an investment point of view, in terms of where you want to be invested for the next several years, then it's strongly suggesting that precious metals, commodities and precious metals miners are ready to have their time in the sun. You can further confirm that by looking at the silver versus SPX chart. Silver versus SPX is a similar setup, actually. You can draw on a breakout line that has actually already broken, and I'll just do that for you. There are a number of these breakout lines. There's one there, we broke out above that, and then another one here. And you can see how you get this series of angled lines, and each time you break above an angled line, it's adding to the evidence that you're forming a base. And this long sideways period of price movement has formed a base which has been supported by this red zone that you can see here. The effect of that now is that it's driving the ratio chart, it's driving the price through the wake-up line, through the Ichimoku cloud, which lies just ahead of us, and then through this cluster of resistance where we have the early breakout line and the final breakout line. That whole zone of technical scientific evidence is what's going to confirm that a full-on precious metals silver bull market versus general equities is indeed underway. So the signs here are good, that a base is formed. We just need a little bit more evidence from the chart to tell us that this really is what we think it is, and what we think the evidence is telling us it is. Other pieces of evidence in this jigsaw puzzle, and this is why, you know, I have to keep saying this, the weight of evidence, Mario, is so important, because I see a lot of terrible, really bad technical analysis, to be honest, online, where people will look at one line or one piece of the jigsaw puzzle and kind of say, well, that means that, you know, because of that, then this is going to happen. Well, you can't say that. Technical analysis just doesn't work that way. The way it works, the way forecasting anything works, whether it's forecasting a horse race, or forecasting what the weather's going to be doing tomorrow, or forecasting what silver's going to be doing next year, the only way to do that is to build an evidence case and to look at the probabilities, because technical analysis doesn't tell you what's going to happen. You only know what's going to happen with hindsight, because you can look back at the chart, you can put your lines exactly where they obviously should have been, and that bit's easy. The forward part of it is a case of assessing probabilities. So we've got a chart here for US M2 money supply, and what this shows you is that as gold starts to get a bigger proportion of the money supply, it sets in motion a bull market. It breaks down through support levels. It breaks down through the moving average, the 3-year moving average here. In fact, I've got the four-year moving average marked on this chart, and actually the 4-year moving average is perfectly fine on this chart, because it gave resistance and it gave support as well, gave relevant support, so that's fine. You can adjust the moving averages, by the way, make 12 month, 36 month, 48 month, 60 month. It's a case of adjusting these moving averages so that they have relevance for the chart that you're looking at. Each chart will need a different moving average to give different signals. Anyway, so the point being that when this breaks down and when it gives a technical breakdown signal, it's telling you that strength is returning to the precious metals market and is leaving other markets. And we've identified the S&P as being one of those that looks vulnerable at the moment. Now, we've got a very typical bearish rising wedge type pattern here. It's capped by a clear resistance line. And then there's a number of ways you can draw the support line on this chart, but I think you get the idea that price is getting wedged up in towards the apex of a rising pattern. So you've got a series of higher lows, and you've got this resistance line at the top, and price is getting squished into the apex of the triangle. When that happens, price has to make a decision. Is it going to break strongly to the upside and have some sort of crescendo upwards, or are we going to do what usually happens with a bearish rising wedge, break to the downside and signal a long-term trend change? And in fact, that's what's happening at the moment. We've broken down from the apex of the triangle, and in fact, if you zoom in and look quite closely, we have this very sort of typical overthrow top, some people refer to it as, or a false breakout, where the price spiked to the upside and then reversed. Now, when that happens, it gives a very strong technical signal that the downside reaction is likely to be quite strong, because it's effectively an exhaustion candle or an exhaustion move that tells you that the real move is going to be in the opposite direction. We've seen this in multiple markets across multiple time frames. Perhaps one of the most significant was the US 10-year yield, which did exactly the same thing with a false break to the downside and a very rapid reversal to the upside. And in fact, commodities charts did that as well, with all of the commodity indices doing the same thing. So it's broken to the downside. We're testing support at the Ichimoku cloud here at the moment, and that really is just about the final support on this chart. There isn't really much more support on the chart. So a move down in the next few months below the Ichimoku cloud, and that's really, for me, signaling another strong piece of evidence that a large bull market is about to ensue. It doesn't tell me that it definitely will happen, but it's one part of a jigsaw puzzle that tells us it's another piece of evidence that suggests that that's where we're going. You can look at gold versus inflation as well. It's important to look at how things are performing versus inflation. The gold versus inflation chart going back almost 100 years here itself is carving out a geometric arc. And don't ask me why this happens. I guess it's to do with the rate at which inflation and money printing is taking place at an ever-increasing rate, which causes the uptrend support line to accelerate to the upside at an increasing angle. So it could well be to do with the exponentially rising monetary base, I suppose, over time, money printing. But gold versus inflation has rebounded exactly where the chart said it should rebound. And if I zoom right into the edge of the arc here, you can see it rebounded very, very strongly, and it's testing a particular overhead horizontal resistance level here. So also worth noting the stock RSI. Some people look at these indicators and they say, oh, it's up at the top here, it's overbought. Well, for one thing, it's actually not quite overbought. It can move higher, as you can see from the previous historical examples here. And the other thing to note is that it can be in this high zone for a long period of time. Look at this big move here that took place from 2018 to 2020. And that wasn't even in a true precious metals bull market. Gold had not broken out versus the S&P at this stage, and yet it had this big move to the upside, and the stock RSI stayed in what some people refer to as the overbought zone for a long period of time, from March 2019 to September 2020, so sort of 18 months. So just because it's up here, it doesn't mean we're about to head down. I tend to view it as more of a sort of a turbo zone. The longer we stay up here, the more prone we are to very rapid moves to the upside. just as a sort of backdrop, that I mentioned the 10-year yield chart. I just wanted to explain this point here is that if you're trying to do some analysis on a chart, I'll get rid of some of these lines here because they're not needed. I'll get rid of the Ichimoku cloud there. So this is the 10-year yield versus inflation, 10-year US 10-year government bond yield. Now, we've been in a downtrend for 40 years. We've broken out of that downtrend. So, and in fact, we're forming a bullish descending wedge at the moment. So if I zoom right in, you can see the bullish setup that's taking place here. It's a bullish pullback on the 10-year yield versus inflation. So I expect yields and interest rates to have another wave of movement to the upside. And don't let that scare you with precious metals, because what happened in the 1970s when precious metals had their biggest bull run in history, well, of course, the 10-year yield and inflation was rising strongly, supported by a support line there. We had 40 years of the 10-year yield descending and falling as money printing took place, and the yield had to be capped in order to allow the debt repayments to be manageable. We've broken out above that, and that's why we've got so much pain at the moment. The banks, for example, all the financial problems that are occurring in the background, I suggest have a lot to do with the fact that we have this paradigm shift in the 10-year yield versus inflation. So back to my original point, if you're trying to look historically at stuff that's happened over the last 40 years to try and help suggest to you what's going to happen over the next 10 years or so, forget it. Just completely forget it. You're doing yourself a disservice because you're comparing apples and pears. You need to compare apples and apples. So if you want to compare apples and apples, you want to be looking back here at the 1960s and 1970s, where you were at least in a similar economic backdrop in terms of yields, inflation, and all that kind of stuff. So just a word of warning, you have to be very, very careful about any expectations that you may have. And that particularly applies to things like tech stocks and cryptocurrencies, which have only, especially cryptocurrencies, have only existed during this period where yields and inflation has been falling and money's been pouring into the stock markets. That is, in my view, slowly changing now. Stock markets are losing momentum, and so just be a little bit cautious about expecting things that happened to kind of repeat in a predictable way. Things that have happened in the last 40 years, do not expect necessarily that to be a good guide going forwards. So that I think pretty much sums up, Mario, what my views are on precious metals at the moment and a lot of the evidence. And this, it all also applies to commodities. It applies to platinum, which probably some people listening will be interested to know. Platinum has underperformed for a long period of time. Always used to be valued more highly than gold, which isn't the case at the moment. So platinum is looking pretty good, and uranium as well, another precious metal that some investors may be interested in. Uranium is looking very, very attractive.
And one question, because I'm sure a few people are going to say, what point is it looking at technical analysis if the powers that be, the bullion banks, manipulate and suppress not just the gold price, but the silver price? Do you think these huge cup and handle formations, especially the silver one, are they an indication of suppression, and eventually all the suppression will dissipate very quickly, or you try to just focus on the technicals? Have you got an opinion on that view?
My opinion is to not have an opinion on that, really. It might sound a bit strange, but because there is so much going on in the background with the markets and stuff that you and I don't know about, the only thing that knows what's going on in that sense is the price itself. So the price itself, the further away you move from the price chart, the more you're moving away from the truth. So if you move away from the price chart and you start talking about the fundamentals, and you start talking about manipulation, and you start talking about what may or may not be happening, that's all further and further away from the actual truth itself. And the truth itself is the price chart. You can't make money on a theory or an idea. if you've got a theory or an idea that silver has a great future, well, many people had that theory or idea in 2015, 2016, 2017, 2018, 2019. So that idea is going to be as valid 5 years ago as it is now. Same with gold, same with uranium, 5 or 6 years ago, which kept on going down and down and down. You can have the right idea, but be wrong for a long period of time until eventually you're right. But that might be 10 years from now. And what is the only thing that can tell you with certainty when is the time to make an investment? And I'd suggested that the only thing that can tell you with certainty is the breakout on the price chart itself, because that is what the algos are going to react to. You see that big spike up there that took place in 2020, where silver moved from about $17 or $18 all the way up to about $30. Well, that happened because we had a confirmation of the price moving above the 12-month moving average, above the Ichimoku cloud, and above this early breakout line. So we had multiple confirmations that that was a buy point there. So the only thing that can tell you that that's happening is the price chart. You get a lot of buzz at the time, and you'll get a lot of buzz when the price comes up here to a resistance level as well. But what's the only thing that can tell you that you've hit this resistance level? It's the chart. You sell into strength here because you've hit this resistance level. You don't become a bag holder. You've set your target. The moment you break out here, you know what your target is. You look at your distance from moving average, and when you become historically stretched, you sell into strength regardless of all the buzz that was going on at the time saying that silver is going to $50. Well, no, silver's not going to $50 because at that point there, it's far too far stretched from its moving average. It's hit its overhead target, which is this wall of resistance here. So I say again, it doesn't matter what fundamental ideas you might happen to have. The only thing that's going to actually tell you the truth of the matter is the price chart itself.
Oh, great. What about the miners, the junior and the major miners? Have you got a technical view on them as well, or don't you follow them? Or
yeah, I've got silver junior miners. So the chart for silver junior miners is quite straightforward to interpret. Actually, it's a wedge pattern with a clear support line and a clear resistance line and a clear breakout level, which I've circled here. So that example that I gave you on the silver chart a moment ago, where silver spiked up by $10 or more, well, that equivalent point is here on the chart in this circle. If we break through this point here, whether it happens now or in a few months' time, when we break through this circle here, that's when you're going to be prone to a spiky move to the upside for the miners that's going to take you all the way up into the resistance zone and all the way up to the resistance line. And that will be the point that confirms that's the time to enter. Because until that happens, we could just reverse and come back down to the support line, and it could take another year before that breakout is confirmed. I don't think it will, but it may do. So you have to, the technical chart is the one thing that can tell you, it's a roadmap, Mario. It's a map. Why would you go on a hike without a map? If you haven't got a map, you've got no reference points, you don't know what's around you, you might be about to fall off a cliff. You have to take a map and a compass with you when you're setting out on a dangerous hike across the mountains. And investing in silver, or particularly investing in uranium or the miners, is the same kind of thing. It's dangerous. If you don't know what you're doing, it's dangerous. So you have to have a map. And the technical chart gives you that map. It puts the whole thing very clearly in context for you. It shows you where your support levels are. Think of that as the edge of a cliff. It shows you where your resistance line is. That's the top of the mountain. And beyond that, of course, you take off into the atmosphere. So all of these analogies, they kind of help to visualize. I find they help to visualize what it is we're doing here. We're trying to minimize risk, maximize gains in the safest possible way.
Okay, great. And maybe quickly look at the gold miners. Are they looking the same, or?
Yeah, pretty similar. Yeah, GDX is usually a good one to look at. Could have picked GDXJ or HUI. It would have been a similar sort of story, really. They've moved very strongly. If you were lucky enough to start accumulating anywhere down near $22 to $25, you've done very well, because we're up at about 33 at the moment on GDX, hitting the wake-up line. And you can see what happened when we hit that line or zone of resistance.
Yeah.
candle just wicked back. So knowing where these lines are, very, very important. You have to know where these lines are. You have to know where these cliff edges and mountain tops are on the chart, because price reacted to it beautifully. It pulled back. It's not ready yet. When it does go through that wake up line, I'd be surprised if it actually stops at the top resistance line here. I suspect a break through this wake up line, and we're going to blast much higher. I think this target up around $60 is quite likely. So we break out above this wake up line, and I think we're likely to slice through that initial target line and head up towards certainly $50 plus, and quite possibly up towards 60 in a very, very strong move. Remember, this consolidation has been taking place for the last 2.5 years now. So the next move when it comes, and also, this is really a sort of a very classic flagpole and a flag type pattern. It's this idea of a strong upside move, then a large consolidation, and then it's such a large consolidation here above the breakout level that I suspect that the energy that's been stored in this consolidation is really going to power a strong move to the upside. It's all, again, as a scientist, this fascinates me because it's all about balance of energy. The energy that's lost during the bear market, and then the gradual build of energy during the base building process, and then the release of upside momentum when you break through these resistance lines. It really is like a beach ball being held under the water. The energy that is stored up, as then it's released, and it moves very, very strongly to the upside. So I expect next move above this wake up line to do the same thing and take us strongly to, I'll say, the $50 to $60 area.
Great. So to me, it looks like a lot of the clues and the maps are telling us that gold, silver, the miners, precious metals in general, platinum, uranium, are all pointing to a lot higher prices, or in relative terms to outperform the stock market. But the key thing here, I guess, is that we need to be patient and not leverage ourselves, because things can take longer than we expect them to. Is that the way you see it?
Oh, it's so important, Mario. Risk and money management is the other part of this. Having good technical analysis and weight of evidence is one part of it, because it helps you to identify the setups that are giving you the greatest chance of success. And if you can do that, if you're able to correctly identify the setups and the charts that give you the greatest chance of success, then the next part, or the other key part of this, is risk and money management.
Great, Kevin. Thank you very much for your thorough analysis. And hopefully, if the precious metals markets wake up finally, we'll be talking again soon. Have a great weekend.
Look forward to it. Thanks, Mario.